do you trade Forex? Know when to buy or sell a currency pair. Forex trading involves predicting the fluctuation of currency values relative to each other. Determining when to buy or sell a currency pair requires fundamental analysis, considering economic factors like productivity, employment, trade, and interest rates. Let's delve into various scenarios. Your USD. If you anticipate a weakening United States economy, you might buy your USD, expecting the euro to appreciate. Conversely, if you foresee a strong United States economy, selling your USD might be preferable. USD JPY. Predicting a weakening yen due to Japanese government actions could lead to buying USD JPY. Conversely, if Japanese investors withdraw funds from United States markets, selling USD JPY could be advantageous. GBP USD. Expecting better economic growth in the UK might prompt buying GBP USD. Anticipating the pound's rise. Conversely, if the UK economy slows while the United States remains strong, selling GBP USD could be strategic. USD CHF. Believing the Swiss franc is overvalued might prompt buying USD CHF to benefit from expected appreciation. Conversely, if weakness in the United States housing market suggests a depreciating dollar, selling USD CHF could be prudent. Trading is typically done in lots, standardized units of currency. Margin trading allows leveraging a small deposit to control larger positions, amplifying both gains and losses. However, high leverage can be risky. A small price movement can lead to significant profit or loss. Rollover fees apply to positions held past a broker's cutoff time, reflecting interest differentials between borrowed and bought currencies. Positive differentials can result in earning interest, while negative differentials incur fees. Understanding these concepts is essential for successful Forex trading, offering opportunities for profit while managing risks effectively. What is a pip in Forex? Let's break down the concept of pips and related terms and explain how to calculate their values. Pips represent the smallest unit of change in currency value, typically expressed as the last decimal place in a price quote. For example, if your USD moves from 1.1050 to 1.1051, that's a change of 1 pip. Some brokers quote currency pairs with additional decimal places, known as pipettes or points. These fractional pips are 1/10 of a pip. For instance, a move from 1.3054 to 1.30543 in GBP USD would represent 1 pipette. Calculating the value of a pip depends on the currency pair and its exchange rate. For example, in USD CAD, where the exchange rate is 1.020, a 1 pip change equals approximately 0.98 United States dollars and 98 cents when trading 10,000 units of currency. Converting pip values to your trading accounts. Currency involves multiplying or dividing by the exchange rate. If the account currency matches the base currency in the pair, divide the pip value by the exchange rate. If it matches the counter currency, multiply the pip value by the exchange rate. While brokers typically handle pip value calculations automatically, understanding the process is beneficial. And for those needing assistance, there are tools like pip value calculators available. What is a lot in Forex? Forex trading commonly involves trading in specific units, called lots, which represent the quantity of currency you buy or sell. Just as you buy eggs in cartons, you typically trade currencies in lots. The standard lot size is 100,000 currency units, but there are also mini, micro, and nano lot sizes, which are 10,000, 1,000, and 100 units respectively. The change in currency value relative to another is measured in pips, which are tiny percentages of a currency unit's value. to capitalize on this small change. Trading large amounts of currency is necessary to see significant profit or loss. For instance, assuming a standard lot size of 100,000 units, we can recalculate pip values for different currency pairs. USD JPY at an exchange rate of 119.80, approximately $8.34 per pip. USD CHF at an exchange rate of 1.4555, roughly $6.87 per pip. When the United States dollar is not quoted first, the formula changes slightly. For example, you are used at an exchange rate of 1.1930, round $10 per pip. GBP USD at an exchange rate of 1.8040, approximately $10 per pip. Your broker may have a different method for calculating pip values relative to lot size, but they will provide this information to you. They handle the mathematical calculations. And as the market fluctuates, so does the pip value depending on the currency pair you're trading. What exactly is leverage? It's the magic trick that allows smaller investors to trade significant amounts of money in the Forex market. Picture your broker as a generous bank that lends you $100,000 to buy currencies, which acts as a good faith gesture, although it's not necessarily kept. Sounds like a dream. Welcome to the world of Forex trading with leverage. The level of leverage you utilize will depend on your broker and your comfort level. Typically, the broker requires a deposit, also known as margin. Once you've deposited your funds, you're good to go. The broker specifies how much margin is needed per position lot traded. For example, if the allowed leverage is 100 to 101% of the position required, and you wish to trade a $100,000 position with only $5,000 in your account, no worries. Your broker will set aside $1,000 as a deposit and let you borrow the rest. However, any profits or losses will be adjusted based on your remaining cash balance. Each broker sets its minimum security margin for every lot differently. In the scenario mentioned earlier, the broker required a 1% margin. This means that for every $100,000 traded, the broker expects a $1,000 deposit for the position. Now, let's say you want to buy one standard lot 100,000 of USD JPY. With your account allowed 100 to 1 leverage, you'll need to put up $1,000 as margin. This $1,000 is not a fee, it's merely a deposit that you'll get back upon closing your trade. The reason behind the deposit requirement is the risk involved while the trade is open. If you're trading losses cause your account equity to dip below $1,000, the broker's system will automatically close out your trade to prevent further losses, ensuring your account balance doesn't go negative. Understanding margin trading is crucial, which is why we've dedicated a whole section to it later in the school. Trust us, it's a must-read if you're keen on keeping your account intact. But for now, let's move on. So how do you figure out your profit or loss? Let's say you decide to buy United States dollars and sell Swiss francs. The rate you're quoted is 1.45 to 51. 4,530. Since you're buying United States dollars, you use the ask price of 1.4530, the rate at which traders are willing to sell. After purchasing one standard lot 100,000 units at 1.4530. Using our previous formula, the difference between 1.4530 and 1.4550 is 02 or 20 pips. So your profit amounts to $137.40. Remember, when you enter or exit a trade, you're subject to the spread in the bid-ask quote. When buying a currency, you'll use the offer or ask price. While selling, you'll use the bid price. Coming up next, a roundup of the freshest Forex lingo you've just picked up. What is a spread in Forex trading? Forex brokers present you with two prices for a currency pair, the bid and ask prices. The bid denotes the price at which you can sell the base currency, while the ask represents the price at which you can buy the base currency. The gap between these prices is termed the spread, or bid-ask spread, which serves as the primary source of revenue for no-commission brokers. The spread essentially embodies the transaction cost, effectively embedded within the buy and sell prices of the currency pair. This cost compensates brokers for providing transaction immediacy. Hence, the terms transaction cost and bid-ask spread are often used interchangeably. Brokerages make profits by selling currency to traders at a slightly higher price than they bought it for, and vice versa, with the difference constituting the spread. This mechanism is akin to selling an old iPhone to a store, reflecting the store's profit margin. In Forex trading, the spread is typically measured in pips, the smallest unit of currency price movement. For most currency pairs, 1 pip equals 0.001. For example, a 2-pip spread for Euro USD would be denoted as 1.1051, 1.1053. Forex brokers offer two types of spreads, fixed and variable. Fixed spreads remain constant regardless of market conditions, ideal for traders seeking predictable transaction costs. They are typically provided by brokers employing a market maker or dealing desk model, where the broker acts as the counterparty to clients' trades. On the other hand, variable spreads fluctuate based on market conditions, reflecting changes in supply and demand and overall market volatility. They are offered by non-dealing desk brokers, who source pricing from multiple liquidity providers without intervention, while fixed spreads ensure predictability and lower capital requirements. They may result in frequent requotes during volatile markets. In contrast, variable spreads provide more transparent pricing and are preferred by traders seeking faster execution. The choice between fixed and variable spreads depends on the trader's preferences and trading style. Traders with smaller accounts and less frequent trading may favor fixed spreads, while those with larger accounts and higher trading frequency may opt for variable spreads. To calculate spread costs, you multiply the cost per pip by the number of lots traded. This calculation enables traders to assess the total transaction cost before executing a trade, ensuring informed decision-making.